This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Hello, this is Hall Martin with Investor Connect. Today I'm here with Pedro Sorrentino, founder and managing partner of Atman Capital. Atman Capital is a cross-border early-stage venture capital firm. Atman Capital invests in the US as well as Latin America. Pedro, thank you for joining us.
Pleasure to be here, Hall, and appreciate the invite.
Great. So where are you calling from today?
I am in Miami.
Great. Well, tell us more about your background before joining Atman Capital. What did you do before this?
Yeah, absolutely. So I've been in venture for about 8 years. So I was born and raised in Sao Paulo, Brazil. I'm 34 now. I moved to the US when I was 21 to pursue a master's at CU Boulder in Colorado. And I lived in Boulder during my early 20s. And after that, 9 years in San Francisco. And then consider myself a refugee of communism, having escaped California, moving to Miami. Just because, during the pandemic, things really shifted in San Francisco, and I just made the decision to leave. And, we still have a partner there, and the Bay Area remains a fundamentally important part of our business. So we have one person in San Francisco, one in London, one in New York, and I am in Miami.
Well, great. Well, tell us more about starting a business in the area of venture capital. What do you look for, and what do you tell the people that are starting these businesses to do before they launch that business?
Our whole ethos is to partner with inevitable people. I think that in the early days of my career as an investor, you tend to have the emotional bias that you want to work with people that fundamentally need your help. And it's actually quite the opposite. You want to invest in founders that make you irrelevant by how competent they are. When we look back at the most transformational companies, it's very difficult to point out that, Facebook, Uber, Google, or Pinterest, or any of these businesses, they were very successful because of investor X, Y, and Z. They were successful because of the founders, and that's why we have a whole 10-step ethos towards what makes a person inevitable. And that's why the ethos behind the firm is to partner with inevitable people. The second part of your question regarding being an entrepreneur in the world of venture, certainly the most important aspect of what we do is have access to capital. Before you're in the business of funding other entrepreneurs, you're in the business of building trust and managing money for other people and their portfolios. And I think that a lot of people starting in venture, specifically the ones that are starting their own firms, forget that before they are in the startup funding game, they are in the money game.
That's a good point. So tell us more about your investment thesis. What exactly do you look for in funding startups?
Well, our investment heuristic, follows a very simple step-by-step process, but it starts with a large market. So usually a bottom-up TAM of $2 billion in 5 years, followed by the whole inevitable ethos. So, it's market, people, product. And by product, we mean the ability of that team to basically fail on a consecutive basis and iterate, ship code fast, and understand that success is actually a combination of a bunch of trials, and you're going to get things right, you're going to get things wrong. But the important thing is to always iterate and iterate fast. So we look for that typical speed/pace velocity of these iterations as well.
Great. And so how are you different from other venture capitalists? What do you think is the most unique feature you have there?
One of the biggest things that we have, and this is something that we spoke with over 100 founders before putting Atman together, is my third chapter in the asset class. And we built this thing that we call the Atman Egregore, which is ultimately it's a community of CEOs. We have 24 today. Now, we have regular LPs, but these are all investors in the fund. And whenever they bring deals to us, we pay them 15% of our 20%, or whenever we bring them to a certain opportunity. And I found that the entire narrative online, or as well as offline, was being reduced, where people were not really sharing the truth. So I wanted to build a place in which folks could be extremely comfortable by really sharing their thoughts, opinions, concerns, while also not only sharing values and principles, but also having the right incentives at the table in order for us to be the most trusted place for these individuals, as well as see deals ahead of others. So this community of entrepreneurs that we put together that invest in the fund, that have leverage in their personal network in the form of the fund, is a key differentiator that we have.
Great. And so what advice do you give to your startups when you fund them? What do you tell them to do after they've launched with a VC investment?
Well, the heuristics and how we're building the portfolio for this fund, it's all about how can we find alpha by investing in a recession. And right now is certainly a prime time to actually find, right, like needles in this massive haystacks, because we have no exposure to any of the noise of people that are having to correct their portfolios or might have overpaid for deals in the past. Since, we only have 3 portfolio companies in the fund. It's a very new fund. All these businesses are overfunded. So more than what we tell them, I would say that is what do we look for, so we don't have to tell them the obvious, right? So typically we're investing in second and third time founders with very, very simple business models that are easy and to scale. It needs to look obvious, and in markets in which you're going to be able to take advantage of, favorable conditions over time. But certainly the horizon for what does it mean for you to raise the next round of financing it's quite murky at this point in time. Meaning that the constant thing that we've been telling all of our portfolio companies right now is to just have a plan for profitability. If you need to activate it and really be mindful of runway. So then you can actually have optionality towards when do you think it's the ideal time to fundraise versus having to fundraise. We're coming from a cycle where a lot of paper markups were happening, and they were happening very fast. And I think now it's going to take far more time for the J curve to mature in an appropriate way. And because of that, these businesses have to have enough oxygen over time. And so cash management is the number one name of the game right now. And it's where we focus our time in terms of the very first type of advice. But, we try to look for entrepreneurs that are fundamentally aware of that before we fund them. I think if we fund someone and we have to tell them about the importance of that, we've made a mistake.
Right. Well, we went through the pandemic when valuations went way up, when the interest rates went way down, and now that situation's reversing. How are your companies doing in this new economy?
So fortunately, we managed to actually execute on multiple secondaries at the end of 2021, which really helped us. And we returned capital to our LPs at a moment in which that was a contrarian move. So we're quite grateful for that opportunity. The biggest change, I think, it's that, we're coming from a place in which if you were growing 15, 20% month over month, and all it would take, it would be for us to get in touch with 60 plus VCs, and in 6 to 7 weeks, you're going to get a few term sheets. That was a formula. That's not the case anymore. And I think that each firm is going through a different stage in time. We have, Y Combinator, for instance, shutting down their continuity fund, whereas on the other side, we have other firms that are still doing growth equity, but probably having to figure out who are going to be the portfolio companies that we're going to save, adding a lot of structure into follow-on capital and so forth. So it used to be the case that you kind of knew who you were meeting with before you met them because of what they've done in the past. But since bad news don't get shared publicly at the same time as good news, the process of raising additional capital right now is just more laborious. The bar is higher and it takes more time. So because of all these things, we immediately start helping our entrepreneurs building relationships from day one, right after we funded them, just so people can start tracking the progress. And it definitely feels like we have returned to a place where how things were 7-8 years ago, where things were far more collaborative, but they took longer to materialize.
Well, great. I always ask this question, what online information source do you find most helpful in your work?
In terms of consuming news and being informed?
It could be, or evaluations or trends or what have you.
Got it. Okay. I definitely think that Twitter is by far the best place. If you follow the right people, I think you can learn tremendously there. It's also not the best for your mental health. So I think you got to be mindful of using it, but it's quite a helpful tool. Being a part of a few private WhatsApp groups is also helpful because there's some sort of level of curation there towards what's happening and what's important and what's not. And lastly, in terms of something that anyone can come in, buy, subscribe, I think that there's this newsletter called The Daily Shot, which consists of basically 200 plus graphs. I don't know if you've seen that one. It's fantastic. Yeah, The Daily Shot. I highly recommend it. And I think it's the most neutral, data-driven way for one to be informed about macro on a global level. I read it every day. I subscribe to more than 70 newsletters, but I don't read them every day. But The Daily Shot, I do take a look at it every day.
That's great. I have to check out Daily Shot. It sounds like an interesting one. Now, in your place, you see a lot of different technologies, new technologies, and new business models. What do you find is one of the most interesting technology business model plays out there these days that intrigues you?
Well, I think the one that we are all searching right now is artificial intelligence in terms of how much that's going to just kill and eliminate multiple jobs that today require a human on the other side, but, have quite a lot of repetition or just have a certain level of behavioral standard. So it's the most interesting one, but it's also the most overhyped, overpriced one as well. And we are significantly valuation sensitive. But the key here is that it becomes a portion of just like how we ask how you met your co-founders or how does the cap table looks like? Have you raised money in the past? If so, when, under what terms, what's your cash and burn? I fundamentally believe that all venture capitalists are going to have a base level understanding of artificial intelligence and ask their companies what's their AI plan. Because if they don't have one, then it's probably going to catch up with them pretty soon. So that's the one that I think you have the highest amount of noise, but also the highest probability of, transformational change over time.
Great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
I think that one aspect that we didn't talk about, it was just what happens on the aftermath of the banking crisis and how to, understand that. We were fortunate to have, because of the community, because of the Egregore, we previewed the crisis and we actually managed to run from the bank a couple of weeks ahead of the actual, the official bank run. And there's still a pretty significant gap in the market that's being covered now by Mercury and Brax. Fortunately, they're, companies led by great management teams that are executing fast, but we certainly need a few more banks that are very startup friendly and just become a small portion of the client base on a diversified basis in order to take the types of risks that SVB took, not on the bond portfolio, but just in terms of managing to understand how to deal with a clientele like ourselves and the entrepreneurs that we fund. So I suspect that we're going to see quite a lot of innovation on regional banks going forward, and most likely with wrapped around software layer, product layer, how Mercury and Brax and Meow, for instance, are working on. And the last thing is that it's really exciting for us to return to a place in which we can build relationships with entrepreneurs versus having to, make a decision in a week and a half with a gun to our heads where deals are exploding. So it was a much necessary correction, although it's quite painful, to just see so many colleagues and friends being laid off. The opportunity to continue to partner with incredible founders is very much out there.
Do you think they could have avoided that bank run? And some say they actually precipitated it with the way they handled it. Do you think that was unavoidable, or do you think that was just fait accompli? All they could do was just ride it out?
Oh, I think it could absolutely have been avoidable. What they didn't understand is that, our asset class is commanded by 5,000 individuals or so that are at the top of the chain and and we all talk to each other. So, there was one WhatsApp group that I was a part of that just on that group, in one day, they took $1.4 billion out of the bank. Oof. So it's a sophisticated, undiversified client base that has the best interest towards talking to each other, right? So they did the most stupid thing ever, which was just jump on a call and say, don't worry, everything's fine. Whenever someone is doing that and not providing specifics, that the house is probably on fire. So the answer is yes. I think they could have done much, much better. and it could have been avoidable, but it would have required a whole nother level of vision and management that frankly they didn't have, because the bank really didn't have a chief risk officer for a long time. And again, it's sad because it was an important partner for the industry.
Right. Well, I predict it'll be a business case study for crisis management in future classes, because a lot of lessons came out of that, and it was pretty clear how it went down, and it's now a new day, but glad everybody got covered and survived. But like I say, I wonder if it could have been avoided, and appreciate your answer on that.
Of course. No, my pleasure.
So how best for listeners to get back in touch with you?
Oh, absolutely. Yeah. So my email is the best way. So P, just the letter P, at atman.vc. Very easy email. I am also, I think, online on every platform out there. So, you know, it's not hard to get a hold of me. You can ping me on Twitter as well. Pedro Sorrentino, at Pedro Sorrentino, but P at atman.vc. Then we can go from there.
Great. We'll put that in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Absolutely. I appreciate the opportunity. Always a pleasure.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Halti Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.